We've got Karthik Kumar now joining us, fund manager at Axis Mutual Fund. Karthik, good to have you with us here as always. Thank you for your time. You got this five-handle GDP number now in the mix. Does it change? How does it play for investors, for people managing money in terms of how you're approaching things? Complicates the situation, or you think it's kind of fully sort of factored in? And in any case, expectation was that Q3 and Q4, both on the monetary side and the fiscal side, things will ease up a little bit. Go on.
Thanks for having me. As you said, it probably complicates a bit. But having said that, we had expected softer numbers given the slowdown in high-frequency indicators and also the fact that the earnings season wasn't as expected. So a lot of it was kind of expected, but the extent of the disappointment probably wasn't. But having said that, if you look at the markets from an earnings perspective, we've gone from an expected earnings for FY25 at 14%, and that has now come down to anywhere between 9 to 11%, depending on the universe you're looking at and the house you're looking at. So I think the earnings cut has already taken a large part into account. As you said, a significant portion of the slowdown happened because of slower government spending and slower credit offtake, which both one could argue that the government has levers going into the second half of the year. So that remains to be something that we need to watch out for.
Karthik, hi. So just give us the overall portfolio construct. It's a complex market that we're navigating, right? I mean, FIs are still selling. The correction, I don't think is entirely over. Incremental local data has started slowing down. So just tell us the market construct right now. What are you long on? What are you avoiding? Just an overall view.
So as you rightly pointed out, FI is still selling, but the pace of selling has gone down significantly between October and November. And having said that, while the markets have corrected, but if you kind of scratch the surface, what you notice is that small caps and mid caps have kind of held off much better or much well in this correction. Plus, if you look at us from a sectoral basis, so something like a real estate, PSU banks, these sectors that typically you think would underperform in these kind of environments have continued to do well, whereas your traditional defensive kind of sectors or sectors that we traditionally associated to do well with market corrections have kind of lagged during this period. So the market correction doesn't, if you look at the market surface breadth, it doesn't suggest that the market is panicking by any means. From a style perspective, again, you see over the last month, it's actually the slightly higher volatility stocks that have done better than lower volatility stocks. Higher beta stocks have done well last month, and even from a style perspective, momentum has kind of done reasonably well over the month, despite volatile November as well. So, and it's done well through the year as well. So those are the things that kind of suggest that while we are seeing market correction, this is more par for the course, and at least it's not panicking based on the market breadth. Areas where I am bullish on through our quant fund essentially is we are overweight. It is more stock specific rather than sectors in most cases, but we are overweight telecom, discretionary stocks. Again, when I talk about consumer discretionary, it is kind of diversified across subsectors and more stock specific. And then pharma, I would argue, is one area that is more sector specific, where there are stocks across sectors that look well. On the underweight side, continue to be underweight private banks. I continue to be underweight commodities in general. Those are the main areas of overweight and underweight.
All right. Hi, Karthik. Good morning and good to see you. Well, at that call on private banks, I recall you've been underweight for some time. And I think at least for now it's worked out. And these FI selling, they'll be selling where they hold the largest amount of stock. And that's actually some of these banking names. But let's delve a little bit into sectors you're overweight on. If you said it's going to be stock specific. But if you could help us out, telecom case in point, are you all playing the core telecom company? If you could give us some idea on that. And dwell a little bit more into consumer discretionary. What do you like out there?
So as you kind of hinted at it, telecom, we are playing through the core telecom companies. In discretionary, it is a good mix of two-wheelers, gold, some gold link plays, gold link companies, and lastly, fast fashion companies as well. That's where we have exposure to on the telecom side. As you touched on within financials, you can bucket stocks within the financial category into different subcategories. And I think capital market plays still look kind of quite interesting versus some of the private banks. Having said that, I'm selectively overweight private bank, but largely private bank as a group still continue to remain underweight. No, largely because there is opportunities elsewhere in that space.
Okay. By the way, just pointing out, the market is down 100 points. So there's no early recovery of sorts. It's still a bit of a slippery slope. Mid-cap index holding in positive territory.
Absolutely. Lots of stuff moving around though, and market breadth is catching up, and that's a good thing. It was steep, it was sharply lower, so 800 stocks were higher and about 1,200, 1,300 stocks were up. And now you got about 1,000 plus stocks in the green and about 1,250 in the red. The divergence is not that sort of large in that sense. As we look at things. Sagility is one name which started lower. It is starting to already sort of pick up once again. Some of this stuff, of course, has done very well recently. AG's Logistics, for example, that is seeing a sharp 7% odd cut coming through. But again, it's had a decent run from the lows recently. And if you look at the Adani Group stocks, it's a kind of mixed picture. Ports is higher. But you look at Adani Energy Solutions, names like Adani Total, they are down, but just some profit booking. But because from the lows, they've also come up quite nicely at this point in time. 115 points lower is what you have on the Nifty. Surabhi.
I just was wondering if we picked out Dixon or not. Dixon is surging on good volumes as well because of the fact that they're making the Pixel phone now. So another marquee sort of logo getting added on in that respect. Anyway, we spoke with the company last week. Their targets are very, very smart in terms of growth and margins. All the businesses are firing across the cylinders, so to speak. Okay, Karthik, so just to go back, you've made the point on the underweight call on financials and consumer discretionary. You said that you like some of the gold financiers. Anything else? Because on consumer discretionary as well, there's been a lot of debate about whether there is this urban slowdown, though I know the Black Friday sales apparently have been a huge raging success, but that's thanks to the discounts.
So slight correction there. I like the gold plays within the consumer space. More like gold retailers, not necessarily financiers. That's on the consumer side. And as I said, very selective across consumer space in general, because while there are positive data points like you mentioned there, but in general, we are seeing the growth being revised downwards, and if anything, earnings downgrades being more focused on certain areas, especially in consumer, both discretionary and the FMCG space. So we are a bit cautious out there.
All right. We'll leave it on that note for this morning then. Karthik, thanks very much. Good to have your perspective in.